Hawaii. To most people, it's paradise. Turquoise waters, golden sunsets, and a laid-back lifestyle. But behind this postcard image lies a deep housing crisis that has quietly grown for decades. Right now, the cost of a median single-family home in Hawaii hovers near $950,000. That's nearly 4 times the US average. And while buyers from the mainland and abroad see it as a luxury escape, for many local families, it has become a nightmare. 3 out of 4 households in Hawaii cannot afford the average home today. That statistic alone is shocking. But when combined with rising insurance fees, aging buildings, and long permitting delays, the cracks in Hawaii's real estate market are beginning to show. So, is the Hawaii housing market actually crashing today? Or is it still climbing higher, only to leave more people behind? In this video, we'll dig into the history, the data, and the future of Hawaii's real estate to uncover whether paradise is on the brink of collapse.
The question of Hawaii's housing market isn't new, but the urgency today feels unprecedented. For decades, affordability has been a challenge, yet in recent years it has spiraled into a full-blown crisis. When you combine wages that have barely grown, interest rates that remain high, and a cost of living already among the steepest in the nation, you create a situation where ordinary families are locked out of the dream of homeownership. Hawaii has officially become the most expensive housing market in the United States, and the pressure this puts on communities is unlike anything seen on the mainland. What makes Hawaii especially vulnerable is its geography and its history. Unlike states that can expand into wide-open land, Hawaii is bounded by the ocean on one side and steep mountains on the other. Add to that strict zoning laws, cultural preservation priorities, and environmental protections, and the amount of land left available for development shrinks to a fraction of what's needed. This has created a structural imbalance where even a modest increase in demand translates into skyrocketing prices. At the same time, Hawaii's beauty and global reputation have attracted buyers with far deeper pockets than the locals who live and work there. From waves of Japanese investors in the 1990s to wealthy mainland Americans and international luxury buyers today, outside demand has consistently driven prices upward. The result is that housing values in Hawaii often reflect global wealth trends more than the realities of the local economy, leaving residents priced out of the very communities where they were born. Meanwhile, renters are also feeling the squeeze. With a median monthly rent close to $2,000, Hawaii's rental market is among the most expensive in the country. Many families spent 40% to 50% of their income just to keep a roof over their heads, leaving little left over for healthcare, education, or savings. This isn't just a housing problem anymore. It's a growing social and cultural crisis that threatens to erode the foundations of Hawaii's middle class. That's why the conversation around the market today is so heated. For some, the numbers still show strength and resilience. For others, particularly local families struggling to stay afloat, the crash has already happened in all but name.
It may surprise people to learn that Hawaii once had too many homes. In the early 1990s, after Japan's economic bubble collapsed, the Gulf War rattled global markets, and Hurricane Iniki devastated parts of the islands, the state found itself with an oversupply of housing. Developers who'd been building rapidly suddenly had standing inventory they couldn't sell, and projects ground to a halt. That moment feels almost impossible to imagine today, but it shows how quickly external shocks can reshape the market. Fast forward 3 decades, and the situation has completely reversed. Today, Hawaii faces a shortage of at least 64,000 housing units, a deficit that leaves thousands of families without viable options. Nationwide, the U.S. as a whole is estimated to be short more than 1.5 million homes, but Hawaii stands apart as the single most expensive state in which to buy or rent. The imbalance between supply and demand here is sharper than almost anywhere else in the country. One of the underappreciated drivers of this shortage has been household size. In 1950, the average household in Hawaii included more than 4 people, often extended families living under one roof. Today, the average has fallen to just over 3 people. Smaller families mean that even if the population had not grown, more individual housing units would still be needed. But because the population has also grown significantly, from just under 500,000 in 1950 to over 1.4 million today, the gap has only widened. Expectations have shifted as well. A century ago, plantation homes measuring just 700 square feet often accommodated entire families. Today, buyers expect far larger spaces, modern kitchens, multiple bathrooms, and parking. Each of these demands adds substantially to construction costs. For example, just one structured parking stall can cost as much as $55,000 to build, and that expense inevitably gets passed on to buyers or renters. Overlaying all of this is Hawaii's restrictive zoning system. Since 1960s, only about 4% of the state's land has been zoned for residential use. That decision was made in part to protect the island's natural beauty and cultural resources, but it has created severe supply constraints. When you add international demand on top of this limited inventory, you create the perfect recipe for unaffordable housing.
When looking at the current state of Hawaii's housing market, the first thing that stands out is the price of homes. The median price of a single-family home rose to nearly $950,000 in 2024, a 6% increase from the previous year. For most households, that number is impossible to reach. What's even more concerning is that prices have climbed at a faster rate than wages, meaning affordability is slipping further out of reach each year. While wealthy buyers from outside the islands may not be deterred, the local workforce, teachers, nurses, service industry employees, simply cannot keep up. Condos, interestingly, tell a different story. In 2024, their median price actually dropped 6%, landing around $600,000. But this is not a sign of relief. Instead, the decline is tied to rising costs of ownership, especially skyrocketing insurance premiums. Natural disasters, from wildfires to flooding, have driven up insurance rates nationwide, but Hawaii has been hit particularly hard. Condo association fees, already the highest in the country, have climbed sharply. Nearly 40% of condos in the state saw monthly fees rise by an average of $135 in just 1 year. For many owners, this is enough to turn what should be an asset into a burden. Renters have not escaped the pressure. Hawaii's rental market has long been infamous, and while growth in rents has slowed compared to other states, the overall level remains among the worst in the nation. With a median rent of around $1,938 per month, Hawaii now sits just behind California as the second most expensive state for renters. The slowdown in rent increases may sound like good news, but the reality is that affordability remains crushing. Many households still spend nearly half their income just to rent, leaving little for other essentials. Regional differences also play an important role. Oahu, home to Honolulu and the heart of the state's economy, remains by far the most expensive island. On the Big Island, however, there are still pockets of relative affordability, with homes in areas like Puna and Ka'u sometimes listed under $500,000. But while these price tags look attractive on paper, they are still high compared to local incomes. What feels like a bargain in Hawaii would be considered luxury pricing in much of the mainland. Finally, there are the state's policy experiments aimed at addressing the crisis. Plans are in motion to build 10,000 units of public housing by 2026, incentivize development around the new Honolulu rail line, and convert thousands of vacation rentals into long-term housing. These sound promising, and on paper they could ease the shortage. Yet progress has been slow, and political opposition has blocked or delayed many of these measures. The gap between ambition and reality continues to frustrate residents, and so far, the market remains largely unchanged.
So why is it so difficult to solve Hawaii's housing crisis? One of the biggest reasons is zoning and land use. With only about 4% of the state's land designated for housing, the ability to expand supply is structurally limited. Efforts to loosen zoning restrictions often run into fierce resistance. Many residents, worried about losing cultural identity or damaging fragile ecosystems, push back against large-scale development. This tension between growth and preservation is at the heart of the housing debate in Hawaii. Another major challenge is the rising cost of insurance and construction. The Maui wildfires of 2023 highlighted just how vulnerable the islands are to natural disasters. In their aftermath, premiums for home and condo insurance spiked dramatically. For many homeowners, monthly association fees doubled or even tripled. Some retirees, living on fixed incomes, suddenly found themselves unable to cover the costs of a home they had owned for decades. For buyers considering entry into the market, these rising costs serve as yet another barrier. The state's aging housing stock adds to the burden. The median age of a home in Hawaii is now 44 years, compared to just 33 years in a place like Texas. Older structures are reaching the end of their lifespan, and replacing them is far more expensive today due to high land values, strict permitting processes, and elevated construction costs. Without higher density development, these replacements will only push prices further upward. Tourism complicates the picture even more. Short-term vacation rentals now make up about 6% of Hawaii's housing stock, with around 34,000 units operating across the islands. On Maui, nearly a third of the available housing in some areas is dedicated to vacation rentals, leaving fewer options for local families. While tourism... So, is Hawaii's housing market really crashing today? The answer depends on how you define a crash. For many analysts, a crash means falling prices and plummeting demand. That hasn't happened yet. In fact, prices for single-family homes continue to climb, and demand from wealthy outsiders remains steady. But for local families, the crash has already happened in a different sense. Affordability has collapsed, and for many, the dream of owning a home is already gone. Population trends suggest that cracks are forming. Hawaii has actually been losing residents in recent years. Between 2022 and 2023, the state lost about 12 people a day, and the following year, nearly 19 people a day. These aren't just statistics. They represent families leaving behind their homeland because they can no longer afford to live there. In the long run, if this outmigration continues, Hawaii could face a shrinking workforce and a hollowing out of local communities. On the policy front, some efforts could bring relief if they succeed. The Kele Momi initiative, aiming to add 10,000 units of public housing by 2026, is ambitious. Transit-oriented development around Honolulu's new rail line could increase density where it's needed most, allowing more people to live closer to jobs and services. Other ideas, like converting thousands of vacation rentals into long-term housing, could free up inventory for locals. But all of these solutions face political hurdles, public opposition, and logistical delays. Without bold reforms, they risk falling short. Another factor shaping the future will be how Hawaii manages its aging housing stock. With the median home already over 4 decades old, much of the existing inventory will need replacement in the coming years. If redevelopment projects embrace higher density, for example, turning single lots into multifamily buildings, costs could be shared across more households, potentially making housing more affordable. But if redevelopment remains locked in the current low-density model, the crisis will only deepen. Investors still see Hawaii real estate as a safe bet, precisely because of its limited land and global appeal. That means prices are unlikely to crash dramatically. Instead, the risk is that locals will continue to be priced out while outside money keeps the market afloat. In the long run, this could transform Hawaii into a place where the people who maintain its culture and identity are no longer able to afford to stay.
Hawaii's housing market is a paradox. On the surface, it looks strong. Home values are high, demand is steady, and investors still see it as a reliable asset. But underneath, for everyday residents, the situation feels like a collapse. Families spend half their income on rent. Young people leave for the mainland in search of opportunity, and retirees who thought they were secure now face rising fees and insurance costs that threaten to push them out of their homes. The crisis is not just economic, it is deeply cultural. Hawaii is more than a real estate market. It is a living community with traditions, families, and values. If housing remains unaffordable for locals, the danger isn't just that home ownership will decline, but that the very fabric of Hawaiian society will be eroded. The loss of community, culture, and connection may be the most devastating cost of all. So, is the market crashing? Not in the traditional sense. Prices haven't collapsed, and in many areas they're still rising. But for thousands of families, the crash is already real. It's the moment when you realize you'll never own a home in your hometown. It's when you see your children moving away because they can't afford to live where they grew up. It's when paradise becomes something you can only look at, not live in. The future of Hawaii's housing market depends on choices made today. Faster permitting, smarter zoning, and bold investment in affordable housing could turn the tide. But hesitation or half measures will only deepen the crisis. The next decade will decide whether Hawaii remains a place for its people or becomes a paradise reserved only for those who can afford it. For investors, Hawaii's housing market may remain resilient. For locals, the real question is survival. Can the islands strike a balance between growth and preservation, affordability and investment, culture and commerce? The answer will determine not just the future of real estate, but the future of Hawaii itself. While tourism is a vital part of Hawaii's economy, it often comes at the direct expense of residents who struggle to compete for housing. And then there are the infamous permitting delays. Decades ago, a developer could obtain a building permit in a matter of days. Today, the process can stretch to months or even years. The Koa Ridge development, for example, spent 17 years tangled in approvals and entitlements before breaking ground. By the time construction began, projected home prices had more than tripled. These delays not only discourage investment, but also lock Hawaii into a cycle of chronic underbuilding.